Welcome back to What's Hot, What's Not, CRE. It's Friday, April 10th, 2026, and we're closing out the week with where institutional capital is actually flowing. Not opinions, behavior. Let's get into it. First up, what's hot? Data centers are the undisputed leader. Investment in AI data center infrastructure is projected to hit $602 billion in 2026. Core fund capital formation for global data centers could reach $50 billion this year alone, targeting returns of 10% or more. Hyperscalers, Amazon, Microsoft, Alphabet, Meta, are driving demand through both leasing and self-building. Power availability now outweighs location and cost in site selection. This is an infrastructure supercycle. Industrial remains resilient, but selective. The explosive growth phase is over. We're back to discipline. Capital is gravitating toward institutional quality logistics facilities with strong tenant credit. Build-to-core opportunities offering long-duration income are in demand. Dallas, Phoenix, Atlanta, and Nashville are the favored markets. Small bay and micro warehouse and last-mile locations remain highly competitive. Vacancy is stabilizing after increases in 2024 and 2025. Mixed-use developments are gaining traction. The standalone office or retail model is fading. Live, work, play communities blending residential, retail, and office are attracting capital in both urban and suburban locations. Diversified income streams hedge against sector-specific downturns. Senior housing is seeing unprecedented demand. Baby boomers are aging. Occupancy rates are approaching historic highs, and new supply is limited. Operators who can navigate regulatory complexity are finding strong risk-adjusted returns. And regionally, the Midwest is quietly outperforming. Columbus, Ohio is attracting institutional capital for multifamily and industrial. Moderate cost of living, pro-business environment, positive population growth. Regional banks are returning to Midwest CRE lending. That's a liquidity tailwind. Now for what's not. Older office is still being avoided. Distressed loans remain elevated, but forced sales are limited, concentrated in obsolete buildings. Investors are selective. High-quality Class A in strong employment markets only. Older commodity office without capital for repositioning is effectively stranded. Sunbelt multifamily faces headwinds. Austin, Phoenix, Sarasota. Significant rent concessions to attract tenants. High construction volumes over the past cycle created oversupply. Investors need to underwrite migration trends carefully. Some Sunbelt markets are now seeing net outmigration, and speculative development is out of favor. Lenders are scrutinizing deals more carefully. Cap rates have risen. Build-to-suit with pre-leasing is preferred over spec. So, why does this matter? CRE investment is projected to rise 16% to $562 billion in 2026. Capital is available, but it's disciplined. Institutional investors are gradually increasing allocations back into real estate, supported by stabilizing pricing and improved fundamentals. Global capital is re-entering markets where pricing has adjusted. Middle Eastern capital wants income visibility. Latin American private wealth views the U.S. as a core diversification destination. The theme is selectivity. Income-driven returns, strong cash flow, long-term demand fundamentals. Asset selection and management are the differentiators. So here's the investor takeaway. Follow the capital. Data centers. Institutional industrial, senior housing, and Midwest multifamily are where smart money is deploying. Avoid older office without repositioning capital and oversupplied Sunbelt multifamily. Discipline beats optimism in 2026. That's your Friday Capital Flows update. Thanks for tuning in. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.